So in this video, I want to talk about how much buying power is required to sell naked options. Now, not all brokers use the exact same formula, but they're pretty similar. The end result is pretty similar. But in this video, I'll talk about Questrade's calculation or formula to determine the buying power required to place naked trades. And I'll show you where the difference can be compared to other brokers. So the formula for buying power required for naked options is actually on their website. So if you go to Questrade and then you go to pricing and then you go, let's say, to self-directed investing pricing, and then you go to margin trading, and then you go to see margin pricing, and then you scroll down, you're going to go to options here. So you see stocks, options, you're going to click on the plus sign near options, and then you've got level 1, level 2, level 3, level 4. Naked options are under level 4, so we're going to click plus here under level 4, and here is where you see the formula for the buying power or the margin requirement. So you've got the strategies here on the side, short straddle, short strangle, but I'm going to talk about naked options, so short options, so naked put, naked call, because once you get this part, the rest is pretty much a derivative of a naked put or a naked call. So right off the bat, you could see that there's two formulas and they basically take the value that is greater. So it's either the value of 1 or 2. So this is 1 and then this is 2, whichever is greater. So let's read this quickly. I'll give examples, of course, but the first formula, the first calculation is a percentage of the market value. So the price of the stock of the underlying security determined using the following value. So for equity options, the margin rate used for the underlying, so the margin requirement used for the underlying for equities, so regular stocks. For broad-based index options, it'll be 10%. So probably ETFs that track the index. For narrow-based index options, it'll be 15%. And then for major currency options, 10%. For non-major currency options, 30%. So I'll explain the percentages with examples. So you've got a percentage of the price of the stock minus the amount that the strike you're selling at is out of the money. So minus any out of the money amount associated with the option. So that's one calculation. And then they're going to do another calculation. They're going to compare both calculation, see which one's greater, and that'll be the buying power required to place your naked trade. And then for number 2, for the second calculation, it's either A or B, depending on whether it's a short call or short put. So we're going to start with put because it's more popular and easier to understand. So with the short put, in the case of a short put position, the aggregate exercise value of the option multiplied by 5% may be higher for certain securities. So what is the aggregate exercise value of the option? So it's not obvious, but it ended up being just the strike value. The strike price that you chose times 5%. But this 5% could be higher based on certain securities. It's not even given to you. You're just going to have to figure it out. But it's not that complicated. I'll give you examples. So I've basically copied this explanation in an Excel spreadsheet to the best of my ability. I've got a market price, I've got strike, I've got the premium, I've got the contract, although I don't really need the premium, but I've got it there. See, other brokers, you will use the premium collected in their calculation. I've got the number of contracts, and then I've got both calculations here. So the capital required in scenario A, capital required in scenario B, and then the max between both scenarios. So let's start off with Facebook, a basic example. The first thing you have to do is see what is the margin requirement for Facebook. So the margin requirement for Facebook, you can look it up under the quote of the stock, and you can see long MR is 30%. So that's the margin requirement for Facebook, 30%. If I go back to the spreadsheet, I'm going to enter 30% here. That's fine. So what is the market price for Facebook? So it closed at 268.11. So I'm going to put 268.11 here. Now say I wanted to sell the 260 put for next week. It doesn't matter. The expiry doesn't matter, but it's a strike that matters. So say I wanted to sell the 260 put for next week. So I'm going to look up Facebook under options. I'm going to go to next week, December 31st. I'm going to go to the 260 put here. I'll just click on the bid and ask. So say I'm selling the 260 put, click sell. You can see that the buying power required or the change in maintenance excess is 72.32. So if I go back here and put the 260 strike, you can see that I get exactly 72.32. So I basically copied the formula right. So what it's doing, it's taking 30% of the market price minus the difference between the market price and the strike times the number of contracts times 100. So that's how you get the capital required for this trade. So 30%. So 30% times 268.1 minus the difference. So minus the amount that it is out of the money by. So $8.11. So minus 8.11 times the number of contract. I've got one contract times 100. So 72.32, which is what I got here. Now, one thing to be very careful with Questrade is when you sell during the day. Right now, I'm looking at this, it is 1 a.m. So this is after hours, market is closed. So this price here, this calculation is based on the closing price, which is 268.11. But if you're trading during the day and the market is open, it's not using the actual market price. It's using the last closing price, which is the closing price from the previous day. So the change in maintenance excess that you see here when you're placing your trade live isn't entirely accurate. It's based on yesterday's closing price and not on the current market price. So there could be a big difference if there is a big difference between the current market price and yesterday's close. So say Facebook yesterday was, Facebook closed yesterday at 280 and it opened today at 268. So you decide to sell a naked put at 260. So the amount that you're going to see on this line here when you're placing your trade live is going to be based on the closing price of 280. So you're going to see capital required of only 6,400. But in reality, it's not taking the current market price. You're only going to get the updated capital required the next day. So the next day, you're going to see your capital requirement for the trade go from 7,200 to 6,400 to 7,200. That's just because when you're trading live, this part here does not use the current market price in its calculation. It uses the closing price. So just be careful. If you're trading something that had a big move, make sure to account for that big move. So if I wanted to sell a naked put on Facebook at 260, I need at least 7,200 maintenance excess. So basically under balance, this is the line that I'm going to need. I'm going to be losing about 7,200 from this line, total maintenance excess. Now the problem with selling naked options is that you enter a trade with a particular capital requirement, but the capital requirement can change on you while you're in the trade. Because if the stock keeps falling, the capital requirement will increase. So let's say you entered Facebook when it was trading at 268.11. You go in knowing that it's going to take 7,200 of capital requirement. But if Facebook keeps dropping, let's say it drops to 260, your capital requirement has increased. It went up to 7,800. Let's say Facebook drops to 250. Now you need 8,500 to stay in the trade, to keep the trade open. So as long as you have the capital requirement, you can hold on to the trade. But let's say Facebook drops to 240. Now you need 9,200. You need an extra $2,000 of capital requirement for this trade. So let's just go back to our example here, 268.11. So when is this column really used? Because obviously there's a big difference between this column and this column. So this column will be used, or the second part of the formula will be used, if your strike is really far out of the money. So if your strike is really far out of the money, then this number here will be way too low. So this is where this formula comes in. So let's say I wanted to sell let's say I want to go to January and I wanted to sell the lowest strike possible, or let's say I want to sell the 50 strike on Facebook. Obviously it's ridiculous, there's no premiums, but let's just say I want to sell the 50 strike. Let's go see how much capital required. Let's go see what the capital required is for this trade. So you can see it only requires $250 for me to place this trade, which is a naked put on Facebook at a 50 strike. So if we go back to our formula, or our Excel spreadsheet, stock is trading at 268.11, but my strike this time is $50. So you can see with this formula, because I'm so much out of the money, this formula becomes negative. So obviously they're not going to use this calculation for my capital requirement. So they're going to use this one. This one here shows a calculation of $500. When I went to Questrade, it shows me $250. If I go to the explanation here, it says that it uses 5%, maybe higher for certain securities. So in this case, it actually did use 5%. So it's basically 5% times the strike price times 100 times the number of contracts. So $250. So in this case for Facebook, it was actually 5%. So I just updated my formula. I put in 5%. So for this calculation, you know what the percentage will be. It's basically the margin requirement of the stock. But for this formula, sometimes it's 5%, sometimes it's 10%, sometimes it's 15%. I guess it depends on the stock, but it's not provided to you, but you can easily figure it out. Let's say we're able to collect premiums, or just for fun. Let's say I wanted to sell January 2023 and I want to sell the 125 strike. As you can see, I could actually collect $5 or $500. Let's see how much buying power is required. $625 is required to place this trade. So it's basically 5% times 125, correct? So if I go back to the Excel spreadsheet and I put 125 over here, there you go. I got my 625, and it's greater than this value here because this value is actually below zero. So the capital required for this naked put is 625. Now, let's see what happens if Facebook drops to 200. My capital required here is still negative, but less negative than before. So this one is still higher. So I still only require 625 in my maintenance excess to be able to hold on to this trade. Let's say Facebook drops to 150 now. So now that it drops to 150, this formula here, this calculation gives me 2,000. So now I go from requiring 625 to hold the trade to requiring 2,000 to hold the trade. Still reasonable. Let's say Facebook drops to 125. I'm going to need 3,750. And say Facebook drops to 0, I'm going to need 12,500, which makes sense. It's basically my strike times 100. Now let's look at the famous Tesla. Tesla has a margin requirement of 40%. Even after it entered the S&P 500, it still has a margin requirement of 40%. So we're going to go back to the spreadsheet. We're going to put 40%, and we'll just put Tesla here. So Tesla closed at 645.98. So we're going to put 645.98. So say we wanted to sell the 600 strike for next week. So we're going to go to option chain. We're going to go to December 31st and say we wanted to sell the 600 strike, which is right here. Click sell. As you can see, it's giving me a change in maintenance excess. So capital required to place this trade is 21,241. So let's go verify the spreadsheet. If I put in 600 as my strike, I get 21,241. Perfect. So the formula does make sense. And that's because I updated my margin requirement to 40%. But if I had left it to 30%, I wouldn't get the same values. Because Tesla is a 40% margin requirement, so this is a capital required for this stock at this strike. Now the difference between other brokers is they will use 20% regardless of the stock. So they won't necessarily use a margin requirement based on the stock. It's always going to be 20%. So with different brokers, it might require you only $8,000 to place this trade. But with Questrade, they use a margin requirement per stock. So in this case for Tesla, they use 40%. So that's really the main difference between Questrade and other brokers in terms of calculating the capital required. And for other brokers as well, this column here, instead of being 5%, will be 10% for all stocks. So different formula, two different things to compare, but it's still the same thing. It's usually the greater between the two different calculations, and other brokers will actually have a third calculation, which is a fixed amount. I think it's $2.50 times the number of contracts times 100 shares. So they'll compare between these three different formulas and take the greater amount. Now let's go back to Tesla. Let's say we wanted to go to January 2023, and let's say we wanted to sell the 200. All right, we could still collect money. Actually, we can collect about 1,700. Let's just go see how much capital required is for this trade. So you can see that it requires $3,000. So where did this $3,000 come from? So if I go to my spreadsheet here and put in $200, I don't see a 3,000. So the reason for that is basically the answer, or the number comes from this column here, which is in this case 5% of the strike. But in the case of Tesla, it's not going to be 5%, it's going to be 15%. So I'm just going to change the formula here. So it's actually 15%, which gives me my 3,000. So if I go back, cancel this. So if I go back to my formula here, or my explanation says, in the case of a short put option, the aggregate exercise value of the option multiplied by 5%. may be higher for certain securities. So this is an example where it's higher for certain securities. For Tesla, it's actually 15% instead of 5%. Now, another example, let's look at SPY, which is the ETF that tracks the S&P 500. You could see that the margin requirement for SPY is 20%. So this one's going to require less buying power, of course. So let's test it out. Let's go to the spreadsheet first. I'm going to put 20% here. And then I'm going to put SPY. So SPY closed at 367.49, 367.49. Say we wanted to sell the 350 strike, let's say. So according to this, it's going to require $5,600 of capital. Now let's go to Questrade and test this out. So look up SPY option chain. I don't know, it doesn't matter. The expiry doesn't matter. So let's go to January 15. And I said we were going to sell the 350, I believe. Yeah, 350 strike. So if I go back, 350, I'm going to have to change it. So 350, I'm going to click on sell. You can see that it tells me change in maintenance excess, 5,600. What did I have in my spreadsheet? 5,680. Perfect. So the formula works. Now, what if I sold a ridiculously low strike? So let's say I sold the 100 strike, just to see if the second part of the formula kicks in. So if I sold the 100 strike, click sell, it requires $500. So obviously it's taking 5%, right? 5 times 100 times 100. So it's requiring $500 for me to place this trade. If I go back to my spreadsheet, it's giving me 5250. That's because I still left it at 15% with the Tesla example. If I change it to 5%, I get 1750. But I need to update my strike. I'm selling the 100 strike. I'm not selling the 350 strike. So if I sell the 100 strike and I updated this formula to 5%, which is what's given to me in the explanation on Questrade's website, 5%. And if I try with the platform, it does in fact give me $500. So I go back to the spreadsheet, it is indeed $500. So the formula makes sense. So if it sounded a little bit confusing, just rewatch the video. I've given you 3 different examples, 3 different margin requirements, and in each scenario, which calculation is used. The important thing to take away from this is when you're trading live, let's say I put the 360 strike, the amount that you see here is based on the last closing price. So if you're trading live, the last closing price was yesterday. So it's not using the current market price. It's using yesterday's closing price. And if there's a big difference between yesterday's closing price and the current market price, then this value here is not correct. Now let's look at QuantumScape. It has a 50% margin requirement just for fun. Say I wanted to sell, I don't know, the 65 strike for January, let's say. So I'll just click anywhere here, update it, pick 65, click sell. You can see it requires $960.50. That's pretty good. So let's update the stock. Let's update the spreadsheet. So the stock is trading on 110.79. Margin requirement is 50%. I'm selling the 65 strike. As you can see, capital required is 960.5. Why? Because it's 50% times 6,500. It's 50% times 110 minus the difference between 110 and 65. So there's a big difference between my strike and the market price. So that's what brings my capital requirement down so much. But guess what? If the stock drops a little bit, I go from 960 to 1500. If it drops to 90, I go to 2000. If it drops to 80, I go from 960 to 2500. So that's what you have to be careful with, is that the buying power changes while you're in the trade if the stock drops. So let's try the naked call. So in the case of a naked call, a short call option, it is the market value of the underlying security. So the market value, not the strike, but the market value of the underlying security multiplied by 5%. Let's give this a try. Let's go back to Tesla. Now notice they didn't mention anything about margin requirement. So let's go back to Tesla. Let's go, let's say to January 15, and Tesla's at 645. So let's say we wanted to sell the 665. So say we wanted to sell the 665 strike, or let's round it up. Let's say we wanted to sell the 700 strike. So we're going to click sell. And as you can see, it's requiring 20,437. So how did they get to that? So remember, we had seen that Tesla, they used 15%. In the case of the put, they used 15% instead of 5%. So we're going to start off with 15%. So 15% times the price of the underlying, which is 645.98. 645.98 times 100 gives me 96.89. So that means they didn't use this section in the formula. They probably used this section. So I'm going to go back, put 40%, put Tesla. Now I designed this for puts, so I'm not sure it's going to work for calls, but let's give it a try. So Tesla closed at 645.98, and let's say we're selling the 700 strike. See, it shows 31, but that's because it thinks it's a put, but it's actually a call. And the formula because the formula is taking the market price minus the strike, but I want to do the opposite now. I want to do the strike minus the market price, because in the case of a call, the strike is higher. So the amount that I'm out of the money by will be the strike minus the market price. I'm out of the money by 700 minus 645.98. With this formula here, it's showing that I'm in the money by this amount, by $55. So I'm just going to change the minus to a plus sign. And there you go. I get 20,437. And if we go back and test it, 20,437 on the dot. So the formula works, guys. The formula works. So yeah, so this actually makes sense. But once again, and especially for calls, if a stock jumps and you sell a naked call a little bit higher, remember the value that you're seeing here is based on yesterday's closing price and not on the new price, especially the price where the stock has jumped a lot. So you could close the day with a certain maintenance excess, nothing has changed in your eyes, and the next day you see that you have a margin call. Most likely it's because you sold a naked option thinking that it required this much capital, but it actually required more, and Questrade made the update the next day because it's based on the previous closing price. All right, so I'm going to update this spreadsheet. I'll make it available. I'm sure many of you are going to ask for it, so if you have any questions, leave in the comment section below. And like always, if you can open an account with Questrade to sell options or trade on the stock market, use my referral link below to get $50 in free trades. And if you found value in this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.